The sharply growing use of a complex oil drilling technique called fracking brought a surge in U.S. oil output over the past few years. At the same time, faltering economic growth in China and the growing number of electric and hybrid cars and other alternatives to petroleum cut demand for oil. In the past, the Organization of Petroleum Exporting Countries, which pumps about a third of the world's oil, would have agreed to limit output. With supply and demand in closer balance, prices would rise. An energy expert in Washington says such market manipulation damages free markets and would get Western business leaders put in a penitentiary. Robbie Diamond is CEO of SAFE, and he spoke via Skype.
And as long as we're dependent on oil for all transportation needs, we will be dependent on oil and to the vagaries of a global oil market that is not necessarily free.
Diamond says cutting oil use in half would help U.S. security and prosperity.
Every recession in modern times has been preceded by an oil price spike. Global events and geopolitics, military affairs are all oil is factored into those.
Another analyst, Simon French of PANMURE Gordon, thinks demand for oil may falter.
Given the speed of technological development, given the amount of renewables investment going on both in the US and China and in Europe, whether actually the calculus starts to be we're going to continue to pump this as fast as we can while we can guarantee revenues.
Meantime, Richard Hunter of Wilson King Investment Management wonders if OPEC can get its diverse members to implement production cuts.
There is an element of some skepticism as to whether these cuts will actually be implemented based on past events. And of course, quite apart from that, there's the rather bigger question of those countries which aren't in OPEC and whether they will be getting involved, most notably Russia.
Making a deal that boosts prices will require some difficult negotiations among OPEC members and other oil producers. Jim Randle, VOA News, Washington.